A very good afternoon, good morning. Welcome to the week ahead video. Now this week, there's only really three things that are majorly getting our attention. And that can be summed up with inflation, inflation, inflation. We're looking at inflation out of the US, the UK, and Switzerland to provide potentially the best trading opportunities. So that's really going to be the focus for the week. There will be some other opportunities sprinkled in amongst those inflation prints, but they're the main ones we'll be looking at. So first of all, Monday, pretty quiet on the calendar, but it's Tuesday where we start to see a little bit of action with the Swiss CPI print coming up. Now, the last print out of Switzerland was 1.7%, which was slightly higher than the 1.6% that was expected year on year. Now, SMB's Jordan has already said that he's anticipating the need for a recognition of the recent strength in the Swiss franc, has pulled back quite a bit since he last said that. But ahead of the hotly anticipated rental rates, that's really what the Swiss are looking at, is where the inflation is in those rental prices. But ahead of that print, if we see this coming in significantly higher, pushing up towards 2%, for instance, that's likely to lift the Swiss franc. Now, if we see a big drop in the Swiss CPI print, that will give the Swiss franc another little nudge lower. So two ways opportunities for the CPI print out of Switzerland, covering that in more detail nearer the time, but it's one definitely not to miss. UK labour data above can also provide some potential opportunities, and also a pound Swiss opportunity may emerge depending if we can get a divergence from the UK and the Swiss inflation outlook. We'll have more nearer the time. The main event of the week is this US CPI print. We know how much the Fed has been focusing on inflation, and with the annual revisions out on last Friday, and Wall Street journalist, Fed watcher Tim Morale said that it was a nothing burger. So they were covering the event. There was upward revisions one way, downward revisions the other, and in the end it's sort of an equilibrium. So that means the CPI print is going to be very, very interesting. Now, expectation at the moment, month on month core to come in at 0.3 in line with the prior, and the headline to come in at 0.2, slightly down from the prior of 0.3. Year on year is 3.9% prior reading and 3.4% for the headline. So taking a look here, you can see this stepping stone action. The Fed's preferred measure of inflation, the PCE deflator, is also dropping. So everything's moving in the right direction for the Federal Reserve, and it's expected to continue to drop lower. So if we see a surprise move to the downside, then that would be good opportunity for selling the dollar. Because the recent move we've been seeing in the bond market, if you just look at here, we had that very strong non-farm payrolls print on Friday at the start of February, 300,000+ jobs added to the US economy, and the December revisions, 300,000+ jobs added to the economy in December, all of which said, oh, hang on, the US economy is doing great. The Fed don't need to urgently cut rates. Then we had that ISM services PMI print above markets maximum expectations. Markets once again said, oh, great, the Fed don't need to cut rates urgently at all. And then we've seen yields continue to push up higher as investors are quite happy with the Fed's narrative, and the Fed themselves are quite happy with the narrative that happy to hold and potentially cutting rates at some point. Remember, the Fed themselves have projected 3 rate cuts this year. Keep an eye on this regional banking sector index out of the US. If there's big worries about the commercial property sector in the US, that can spill over to the bond market, and that can result in some strong bond buyers. So you can see there, when we saw that regional banking index move significantly lower, did start to get some bond buying coming back in. This is starting to bottom, and as long as that story remains sort of in the background, then the bond market will mainly be driven by rate expectations, and that will mainly be driven by what's going on in the CPI print on Tuesday. Remember, at the moment, markets are expecting, 5+ rate cuts expected last week. Now that's gone and changed. So you can see now markets looking 3+ rate cuts. So we have seen a pricing change. So a good opportunity here would be if this comes in significantly below expectations. If this is a surprise CPI miss, we'll look for dollar selling, and you could just look for euro US dollar upside would be a simple go-to pair. Then get on Wednesday, we got UK inflation data. Remember that last Bank of England interest rate decision? It was a funny one. We had Davish Dhingra voting for a cut, and then we had Mann and Haskell voting for a hike, and then the rest of the Monetary Policy Committee members were right in the middle of the and wanting a hold. So what we want to see here is something that sort of pushes the dial clearly one way, and if we see come back nearer the time, we'll look at the maximum expectations. If it comes in much higher than markets are expecting, then we can see another little leg higher in the pound. Markets desperately looking for a reason to sell pound. Catherine Mann this week, last week, by the time this video is released, sort of said that, if she starts to see service inflation dropping, then she'd be more likely to move from a hike to a hold. So a big miss in the CPI print, and then the pound could see some quite rapid selling off. Markets have been waiting for a reason to sell the pound. GDP data's coming out for the UK this week, and the UK GDP should fall into a minor contraction. You can see here prior minus 0.2%, the year on year 0.2%. So the quarterly reading is expected to fall lower. The broad outlook here for the year and the quarter on quarter print is for a minus 0.1% was the prior reading, and most analysts are expecting this to drop lower after that really weak December retail sales print out of the UK. So another miss here, below, into sort of negative territory, and then the UK is officially in a technical recession. Shouldn't necessarily make much of an opportunity for the pound unless we see some real outer consensus prints, but just to be aware of that technical recession possibly heading up for the Eurozone. Then looking forward as we go to the end of the week, we have some other sort of spattering of opportunities that we will cover, but the main ones are those CPI prints. That's what's really going to move the dial. Don't forget, at the end of the week, we've got the University of Michigan sentiment. This is a preliminary reading. You get two readings in a month. You get the preliminary and the final. So if anything's going to move markets, it will be the preliminary reading. Always worth being aware of that towards the end of the week at 3 o'clock. So there we have it. It's really inflation, inflation, inflation. Some potentially great opportunities here. We'll be keeping this all covered, getting us completely up to date and ready to act on any actionable deviations, and we'll be informing folks during the rest of the week.